Hello and welcome to Bondcast, a podcast series where we discuss our views on the latest themes and events shaping rates markets. I'm Imogen Bachra, UK rate strategist, and I'm joined today by our global market specialists, Giles Gale and Jan Nevruzi. Now, before getting into today's discussion, I just wanted to let all of our listeners know that after today's episode, we will be taking a 2-week break in the last 2 weeks of summer. So no Bondcast for the next 2 weeks, but we will be back to report on all the action that we've missed on the week beginning the 5th of September. So you can look forward to a post-summer catch-up that week with Bondcast. Another what should have been a quiet summer week that actually wasn't, pretty volatile markets, a lot being driven by the UK and the US. But since I'm already talking, Jan, I'm going to start by asking you questions on the US. Let's start with the Fed minutes. I suppose they were probably really one of the more important events this week. We obviously had the Fed meeting a couple of weeks ago, and since then we've had Fed members from across the kind of hawk-dove spectrum come out and suggest that the market interpretation of a Fed pivot was perhaps a bit premature, and that they were still on this hiking path and saw significantly higher rates still. Did the minutes reflect that more hawkish tone? Was it as you were expecting, or were they slightly more dovish?
I wouldn't say the minutes were necessarily hawkish. The markets interpret them as a little bit more dovish, but for us, it was more so kind of going around the central tendencies of a lot of give, a lot of take. There was focus, of course, on or at least what headlines grabbed right away was that that the Fed at some point might have to slow down the pace of rate hikes. So what that at some point means is pretty vague. It certainly doesn't have to mean September. In the past they've kind of tipped it out into making into a 3 to 6 month period. So that would imply that after September, anything is on the table, deceleration or even deceleration in September. The other thing that markets really kind of took to heart was that the Fed is worried about that they could tighten policy a little too far, overdo it, and end up overshooting because monetary policy works with lags. So what markets took away from that was that the Fed is starting to worry more about growth and less about inflation. We don't think that's right. In fact, Powell was asked that almost verbatim at his July press conference, where he started the response with the same exact thing, that, well, we're not trying to overdo anything. We're not trying to make a mistake. And of course, there's a risk that we can overdo it. However, and then that however goes on for to describe how entrenched inflation is actually a much bigger risk, and how allowing that inflation to be entrenched would lead to a lot more problems down the road than overdoing it and kind of maybe killing demand for the next quarter or something like that. So those are pretty balanced. There was a lot of underscoring of the strong strong economy, like the labor market, worries that GDP might come lower or even get revised higher. So it was definitely a mixed picture. I don't think it changes anything for the Fed September path. And let's not forget that this information is, well, at least now we have about almost 4 weeks of additional information compared to what they did at the meeting. So these minutes always feel a little bit outdated. And if anything, we know that the Fed still has ways to go bringing the real Fed funds rate closer to where it has been historically, kind of like running, call it something 1% below trend GDP, which is when really these so-called pivot points happen. So in our view, no, nothing has changed. It was a lot of noise for not much information, and people will be kind of looking forward, I think, and minutes were fairly balanced in my view.
I think that's often the way with these minutes, isn't it? A lot of so not a lot of info. So the other thing I guess we've had a lot of this week is data out the US. It's been a bit of a mixed bag, I suppose. What's your key takeaway from, or what do you think is the kind of key message here from the data prints that we've had this week?
The key message is, like you said, we had mixed data. Starting the week, it was a very slow number, or very weak number in New York for Empire State Manufacturing, which implied, okay, well, maybe August started on a pretty weak footing with respect to manufacturing. And then you get industrial production, which comes above expectations, even though that covers July, and we could see some deceleration in August. Then today you get the Philly Fed manufacturing, which also tells you manufacturing is actually not doing so bad. So a lot of mixed signals. Of course, housing data continues to disappoint on the downside. But even back to the minutes, as they pointed out, and as most market participants agree on, housing was going to be the sector that had a lot of froth. Got really built up prices got built up during the pandemic, and it is heavily interest rate sensitive. So as interest rates go up, as the Fed tightens policy and mortgage rates follow alongside, seeing this kind of slowdown in the housing market is not really all that surprising, which at this point markets have kind of almost looking past. They didn't really react that much. They reacted more so to industrial production when that came out. So, and today finally we got lower kind of deceleration in the weekly unemployment claims. So all in all, I wouldn't say that we're really deviating from trend of, a recession might be in the books, but it's not really today's story. And we're not really changing the path for the Fed all that much. I think housing is weak as expected, but the rest of the data is holding off pretty well, which in my view is enough for the Fed to maintain the kind of tightening pressure or the desire to go in that direction.
And just to round off the discussion on the US side, next week is Jackson Hole, of course, the Fed's kind of central banking forum for listeners that aren't aware, although I'm sure you all are. And, markets tend to look at things like Jackson Hole and the ECB equivalent, so Sintra, as being potentially big risk events. I suppose in the past, they've been used to signal, changes in monetary policy direction from major central bankers. So we always kind of look with anticipation to Jackson Hole at the end of August. And of course, it kind of marks the end of summer holidays as well. How are you thinking about Jackson Hole next week? It's obviously early days. We don't yet, as we're recording, have the schedule of speakers or which other central banks are going to be attending, but I think we can probably be fairly confident that Powell will be there. Is this the moment for him to announce any other kind of pivot? I'm taking from, given the fact of everything else you've just said, probably not, but how are you thinking that the risks are skewed for Jackson Hole?
I think I'll focus on three main things that I'm looking at for at Jackson Hole. Like you said, we still don't have the topic, and we will likely get it later today, but at the time of recording, we still didn't have that information. And one thing to keep in mind for Jackson Hole is that the Fed and generally policymakers have been trying to transform Jackson Hole into more of a long-term policy informative type of an event, rather than this is what we're another channel of communicating imminent Fed moves. So the three things that I'm really looking for, first is I don't expect any pre-commitment to a 50 or 75 basis point hike at the September meeting, because the Fed has been, I'm not going to say burnt, but kind of have been caught off guard, locking themselves into a position and then having to change that, leading to a lot of sort of bad volatility, unwanted market reaction, pricing in more cuts down the line. Overall, not the way the Fed wants to communicate policy. As Bernanke had said, 98% of central banking is communicating and just 2% is reacting. So when the communication channel fails, it's not good news. So no specific locking into a decision. Second, I think Powell will remind markets that the Fed has still a lot of tightening to do, that inflation is far off target, and that there is a lot more that's needed. Of course, that I don't know if he's going to underscore risks to growth, but I think he's going to bring focus back on inflation. And despite a weaker reading, that doesn't mean that they've won the fight against increasing prices. And finally, you asked about the sentiment of how I think he could, tweak his tone. So the minutes also talked a lot about the FOMC members being happy about tightening financial conditions, because that's kind of their way of combating inflation through the demand side. But since the meeting, financial conditions have actually loosened. We had a broad-based stock market rally. Bonds haven't really done all that much perhaps even slightly lowering yields now. And overall, the picture from financial condition side has been better compared to when those minutes were dated. So if he wants to maintain pressure, he could just go out and lean marginally hawkish with his choice of words. But I'm not so sure even Jackson Hole is going to be the event for that, because Powell also added to his schedule was added a speech on September 8th, right before the blackout period, where he's going to have another set of jobs numbers, and you could just use that to factor into their decision. You could just use that speech to convey anything that he wants to, specifically with regards to monetary policy. So unfortunately, or maybe fortunately, Jackson Hole might not be the monetary thunderstorm that people are looking for, and instead a very academic and longer term picture of the economy, or their view of the economy. Okay, moving on to the UK then, and inflation surprised to the upside, now hitting double digits for the last month, and was definitely a large reason for the moves in the markets. What's your take on that?
Yeah, I think the upside surprise in UK inflation has been a big driver of fixed income this week. It wasn't a huge beat to expectations, I suppose, given the kind of levels of inflation that we're talking about, but it was pretty symbolic in that inflation, as you said, is now, headline CPI is now double digits. So it was pretty headline grabbing, I suppose, in the UK. It came at 10.1% versus market expectations of 9.8%. And it was pretty broad-based, I suppose, when it came down to the details. It was broad-based price pressures. A lot of it was being driven by food inflation. But the fact that there was this kind of broad-based increase across sectors validates, I suppose, the view that we had before, that although we may well be close to the peak, we think that inflation pressures are going to be pretty sticky from here on out. As a result of the inflation print that we had this week, and also the movement that we've seen in natural gas prices, we've now again updated our forecast such that we now have a later peak in UK inflation, and that peak is also higher. So we've pushed back the peak from October, which we had originally, to January, and now see headline CPI, which is what the Bank of England target, at 12.9% in January, and that will be the peak in our forecast. I think it's worth noting, particularly when it comes to markets and to the Bank of England, that although that is the peak, like I said, we think that this will be fairly sticky, and although it does come down after that, it doesn't come down anywhere close to the Bank of England's target really until 2024. We have headline CPI still at 4% and core CPI still at 3% by the end of next year. So I guess in terms of the takeaway for the Bank of England from this week's data, it really just validates our recently updated, more hawkish view that they're very likely to do 50 basis points, I think, in September and November as well. Market pricing was already pretty much in that direction. I think we had about 45 basis points priced in for September, and probably about 40-ish when we were recording this last week for November, and now that's pretty much fully priced, which I think is a go with. There was nothing in the data this week, not on the inflation side nor on the labour market side, really, that would make you think that they were likely to slow the pace of hikes from August to September.
Fair enough. Yeah. I guess when inflation kind of hits that double digit symbolically, it makes people worry even more. But okay, well, so you also updated your gilt call this week, quite remarkably higher, but given the volatility, we might get there very, very quickly, it looks like. So can you walk us through that?
Yeah, I was a little bit worried, given the moves that we were having at the beginning of the week, that we might actually reach the target before I'd managed to publish the note, but alas, not quite. Yeah, I guess, I will just caveat this by saying that the kind of, upside surprise on inflation wasn't really the key driver for updating the gilt call this week. It obviously was just a happy coincidence that pushed markets in the right direction when it came to our kind of renewed bearish conviction. Regular listeners will know that we've been flagging the fiscal story, I would say, on the UK for some time. And it just really feels to me like the market is still massively underpricing this. We saw the press over the weekend and broadly over the last couple of weeks, the media has been super focused on what Liz Truss as a Prime Minister might mean for the Bank of England and the changed mandate and what that means for the monetary policy outlook. And not really at all focused, I don't think, on what she may mean or even what Sunak might mean for the fiscal metrics in the UK. And actually, I'm pretty glad that we did manage to get the note out when we did, because the IFS overnight have just published their take on the deteriorating public finances in the UK, and we came to a pretty similar conclusion. Not suggesting that they read my note before they published theirs, but I think the backdrop here is that there's been a clear deterioration in UK public finance since the OBR projections back in March. I think we've talked about this on the podcast many times before, but the macro backdrop has worsened. Inflation has risen significantly more than they were expecting back in March. Rates are higher, so interest expenses are higher. And that all boils down to a worse starting point when it comes to how much borrowing and how many gilts are going to be required this year. And you overlay that with a fiscal easing that we already had back in May that hasn't been kind of accounted for yet in any updated remit, any updated gilt remit. You have likely tax cuts that if Liz Truss is going to be Prime Minister, which polls are making that look seemingly quite likely at this point, tax cuts which are pretty expansive but also being brought forwards compared to where she might have originally planned to do that, and probably quite a high likelihood of some emergency package of measures as well being announced pretty soon after she does become leader of the Conservative Party and Prime Minister, if that is what is going to happen. There's going to have to be some extra layer of support against these rising energy bills to support the consumer, and so once you add in all of these factors, I think that there's quite marked deterioration in UK public finances to come. And markets aren't focused on that right now, but there's a lot of risk events over the next couple of weeks, which I think will focus markets' minds more on the issuance side of things. We'll get the Q3, next week, the DMO will meet with investors and GEMs about their Q3 issuance calendar. We'll get the meetings the next day, next Tuesday. And then we'll get the calendar at the end of the month. There's then a syndication window in September, which is after Liz Truss, after the results of the leadership election. And then we'll have, of course, the September Bank of England, which we expect a confirmatory vote on QT, and then a likely start date of QT. So you have all these fiscal pressures adding up on one side, and then you overlay that with the likelihood of active sales by the Bank of England, which I've mentioned this so many times on the pod before, but it's not just about how those bonds that the Bank of England are selling add to supply risks in the first instance, but also about how the Bank of England is most likely to be selling those bonds at a loss, and that loss has to be covered by the Treasury. So there's kind of a second order effect on supply there as well. So it seems like a perfect storm of fiscal risks here, which all add up to higher yields and aren't being priced fully, I don't think, by the market. So putting together, everything we think about on the kind of supply side, how we see QT evolving, and then of course, what we think about inflation and our growth forecast. And we have an updated target of 3% now in 10-year yields. So still quite a lot higher than where we are now. Not as high as it seemed at the beginning of the week, but a fair amount of bearish conviction, I would say, in the UK. And for anyone that's listening and wondering whether the 10-year point is the best part to play on the curve, we think it is. It's not just us being lazy suggesting 10 years. We think that looks like the richest point on the curve, and we prefer to play it as just kind of being an outright short duration view rather than a curve view or on asset swap at this point. I will stop there. That's probably enough on gilts for now. And Giles, let's round off this week's discussion then with Europe. I think it's been a little bit in the back seat this week with everything that's been going on the data front from the UK and the US. And European bonds were really largely following the UK and the US, although I know we're recording this on Thursday, so that was really only up until this morning when actually Europe started leading the way higher off the back of Schnabel's hawkish interview that was published this morning. How do you view her comments? Are they kind of in line with how you're expecting ECB policy to evolve anyway over the next couple of months?
Yeah, I really wish that I had all these meaty things to talk about that you guys have, and I really think that your recognition of these big themes coming together in the UK is super important. What do I think about Schnabel? Mostly unsurprising, to be honest with you. I mean, maybe the most surprising thing is that we heard anything from her at all, because usually what happens is that the first time you hear from anything from the ECB after the summer is pretty much at that September meeting. So maybe just recognizing that they're doing a little bit more hand-holding than normal. But what the key messages were a little bit on the bearish, hawkish side. She sort of recognized recession risks, but didn't really give any additional weight to those compared to earlier in the summer. She was very focused on inflation, which and inflation risk. She talked about the importance of watching current inflation, that just being important in the mix when it's so difficult to forecast inflation. I think that's a shift that all central banks have made. And the bottom line was really, I think, that it was a message which was very much in line with a 50 basis point move in September. And I think that was really the key takeaway. There was one other thing which, I think was really just a flag for the future, perhaps, around the possibility that the reinvestment in of APP holdings could come up in the months to come. And she didn't really close down the question that, in fact, she accepted that maybe that would even come up from somebody from somewhere at the September meeting. I don't think it's for the September meeting, but clearly that's on the radar.
Yeah, that would be a hawkish shift, I suppose. But I guess now they've mentioned it, that's definitely going to be asked in the Q&A at least in September. So I guess just more broadly about rates then, I think we talked on this podcast last week about how we felt globally really that the market had overpriced perhaps its recessionary fears. And, I've then talked at length today about how we see other factors at play in the gilt market too. And we think that there's clearly a lot further to go in gilt yields. We've already done quite a bit this week across the board on the UK side and in Europe. But how much further do you think there is to go in Europe, if at all? Are you still pretty bearish there too?
Yeah, just as you've already said, not necessarily quite as much as in the UK, but I think that many similar factors are at play. I still do think that the market has become too economy pessimistic. Obviously, in Europe, the whole gas story is still dominating sentiment, and I think most people view that as unmitigatedly negative. I already mentioned a few things last week. It's not the right moment to go back over all of that, but I think that the pessimism there even is overblown as well. I'm sure that there'll be a lot more to talk about in a couple of weeks' time when we come back and update it again at the beginning of September. But to answer your question very simply, I think that yields do have a lot to rise back to, potentially back not far from where they were at their peak in late spring. So we still have this 1.75% target for 10-year bonds. Very comfortable with that.
Nice. Lots of bearish conviction here then. All right, let's wrap this up here. And just a reminder to our listeners, as I mentioned at the beginning of the pod, Bondcast is going on a couple of weeks break. So we will be back the week commencing the 5th of September. So I think the first episode should hit your inboxes on the 9th, if I've got that right. Let's hope. But until then, enjoy the last few weeks of summer. Hopefully we can get a couple of quiet days, and I'm sure there'll be lots to catch up on when we get back. And thank you both for joining. And just a reminder, if you liked today's episode, don't forget to hit the like button and click subscribe so you can get the latest episodes as soon as they're available. Thanks.